Ghana or in Ghana's context, how they differ based on their asset allocations, and how they generally work. I would also like to take the opportunity to conclude with some skill set that is needed aside the qualification of GISI to succeed in the industry, either as the portfolio manager who takes all the decisions or who does all the technical analysis, or as the relationship manager who interfaces with the clients. And then we can conclude with some questions and answers to make the program as interactive as possible, because they made that indication already. And so can you please proceed to the next slide, please? Okay, so I'll simply just start with by answering the question what collective investment schemes are. And you can see that there are three words that have been bolded there. There are several ways of defining collective investment schemes, but no matter how you look at it, you cannot define it without these three essential parts, which are highlighted in the test. As you cannot prepare, of course, soup without adding some known ingredients to it. So our first part, it says that collective investment scheme is a pool of money. What this means is that it's an arrangement where several people come together to contribute money towards a common goal. These people can be either individuals, who we call retail, or they can be corporate, they can be clubs, they can be churches. Anyone can or have the muscle to operate or to play in the CIS space. Now, after putting these monies together from these investors, the next thing is to invest this money in securities, which can be shares, government of Ghana instruments, real estate, what have you. And to be able to take that decision on these securities, you need a professional manager who should be licensed by the SEC to take that decision on the portfolio. Before the investment, the law requires that the manager must have done all the analysis and must invest within the guidelines specified in both the SIA, which is the Securities Industry Act 2016, and the Unit Trust and Mutual Fund legislation, as well as any restrictions that the scheme particulars imposes on the fund. And so all those guidelines must be put together in order to operate or in order to take the decision as a professional manager. So are there benefits in having this arrangement at all? Someone will say yes, someone will say no. Of course, if you have the financial muscle to go onto the market, buy things on your own, there could be some advantage in that, but you also stand a chance of not being able to spread the risk as it may be. And so by having a CIS in place, you have access to a professional investment manager, which I have mentioned already. Of course, on your own, it might be almost impossible for you to be able to hire a professional to manage your funds for you. In addition to that, CISs are very low cost. If you have as little as 50 cedis, or in some cases even 20 cedis, you can open an account, a CIS account. What else does it offer in terms of diversification? So you get to share your risk with other investors. Instead of you going into the market and say, I'm buying two shares, in that when final price declines today by 5%, you as a final shareholder will stand a chance
go to registration and academic information,
or the value of your shares will decline.
You see the difference between GISI and CISI.
A system of the CIS, you are able to share your risk. You won't only bear the 2% alone, but it will be spread across the whole fund as you have it. And you can walk in anytime and get out anytime. Of course, some have specific conditions where monies will have to be there for 5 days before you can have access to it. In terms of after you filled your redemption form, it can take up to 5 days for you to get your money. but it depends on specific conditions for specific funds. There is transparency. You can get access to your account or your value on daily basis. And finally, there is a tax benefit. So unlike directly buying shares onto the from the market, where your dividends will be taxed as a unit holder or a shareholder in a CIS, you get to enjoy the benefits of not being taxed on your gains. Are there costs to this beautiful arrangement? Can you please enter for me? Okay. There are definitely costs to this arrangement. So there is what we call management fee that the fund manager or the professional manager needs to be rewarded, and that is something, a token if you compare to the kind of work that is being done, and if you compare it actually to what returns you are making. The second thing is that you lack the choice of being able to take control of your own shares. You cannot decide that because I am a shareholder of Databank Balance Fund, they should buy shares in enterprise. That cannot be done. And so then you don't have that choice to be able to decide on where these shares or where the securities should be placed. And finally, so as a shareholder of, let's say, FANMOS, you can walk to AGMs and you are entitled to vote on decisions or on resolutions. But as it stands now, as a shareholder of a unit trust or a CIS, you cannot have that flexibility. So now what we know, sorry, can you please go to the next slide? Can you please go to the next slide, please? So now that we know what CIS is, let's briefly look at what types there are briefly. So all CISs come under any of these classifications. It can be an open-ended scheme where the scheme continually issues shares or units to investors, or it can be a closed-ended scheme where the scheme issues a finite number of units or shares which may be traded on an exchange. Or there is an exchange-traded scheme where you just look at the holdings in, let's say, Ghana Stock Exchange Index and say that I will want to hold all of that as a scheme. And so then you build a portfolio around it and open it up for people to buy into it. So with this brief description, we just turn our attention now to CISs in Ghana. So in Ghana, CISs take the form of mutual funds or unit trusts, and they are regulated under the Securities Industry Act 2016, Act 929, and the unit trust, sorry, and mutual funds regulations. Sorry. So you realize from the previous submissions, I tried to limit my reference to CISs in general to mean both mutual funds and unit trusts as schemes. And indeed, there is very little practical distinction between unit trusts and mutual funds for the average investor in Ghana. They are governed by the same legislation, the unit trust and mutual funds regulation. Both of them must be licensed by the SEC, and both must be managed by a professional. But by law, however, a mutual fund is a registered limited liability public company under the Companies Code. And so they are expected to behave in a certain way that is slightly or totally different from how trusts or unit trusts behave. For instance, a mutual fund is required by law to have a board of directors by virtue of it being a company. And they are also required, of course, to be having the quarterly board meetings, to have all the subcommittees that comes with a board. Unlike the unit trust, which is an arrangement that is registered under a trust deed. And so that is not a company. There is no requirement to have board of directors. What they have is board of trustees, or trustees for that matter. And so most decisions that they take, for mutual funds, their monies are supposed to sit with the custodian, but with unit trust, their monies are supposed to sit in a trust account, which can either be with the trustee or outside of the trustee. But in order for the trustee to have a view on where the monies are being invested, they are the signatories to the trust account, just to offer investors some flexibility or some security in there. In terms of what interest, so for investors who invest in mutual funds, they are called shareholders. Of course, if you're a company, you issue shares. And then for investors who invest in unit trusts, they are called unit holders. Please enter for me. Okay, I've exhausted this slide, so please go to the next slide. So for the rest of this presentation, I'll be using them interchangeably, mutual funds or unit trusts, as it may be. I've just spoken about the legal setup. In terms of their operation, it's very similar. It's the legal setup that differentiates them. So CISs can be categorized again according to the way they allocate their assets to the portfolio. Please enter for me. Okay, so there is the equity mandate. So when a CIS allocates 50% or more of its assets to equities, we say that it is an equity fund, or it has an equity mandate. And then if it has in between 50% or up to 50% in equities, and then the rest in fixed income, we say it is a balanced fund, or it has a balanced mandate. And the fund uses most or all of its funds monies to buy fixed income securities maturing within a year. You say that it is a money market fund, or it has a money market mandate. And then if it uses the money to buy fixed income instruments with maturities beyond a year, it is a fixed income fund. And finally, we have some funds that invest their monies in either units of real estate properties or financing real estate projects. And in that, you call it a real estate mutual fund or a real estate unit trust. And in Ghana here, we have the Republic Trust, Republic Real Estate Trust. Yes, that is what we have in Ghana here for the real estate fund. But in terms of the other funds, we have more than 60 mutual funds and unit trusts in Ghana that investors can choose from. But as professionals, I'd like to emphasize that it is the responsibility of you and I to properly guide and educate our investors to enable them choose the right investment vehicle that satisfies both the reason for which they are investing and how they will react, paying attention to how they will react if they lose any part of their money. And that is essentially to take care of the risk part of investment. So for the next three slides, I'll just use the Databank funds to show you what it means to have an equity mandate and the other mandate. So for instance, at Databank, we have the M fund, which is a fixed income fund. If a client invests or wants to invest to get some interest but will not be able to withstand any decline in their money, then we say the investor cannot accommodate risk, and so we will have to shepherd the client to M fund. On the very extreme, which we have here as EPAC, where investors can accommodate some declines in their monies it's not just some declines, but EPAC, it means that the investor really understands that if I come today and the value of my fund has declined by 20,000, assuming I brought 100,000, which essentially means a down or a negative return of 20%, I won't react violently, or I won't be much worried, which means that the clients can take some risk. In terms of how the asset allocation is done, you can see that, so we can invest up to 5%. This is for EPAC, for liquidity purposes in either cash or the collective investment schemes. And then we have, we can invest up to about 15%, and that is regulatory in unlisted equities that are not listed on a regulated market. We can also invest up to 80% of the total value of the fund in listed equities. And currently we are invested in Ghana and 6 other African countries. And to offer some stability, some form of stability to the fund in times of intense volatility in shares, we can do up to 45% in fixed income. So all these limits or restrictions are spelled out in the laws that governs the fund, and at times it includes directives from the board of directors. And this slide touches on balance fund using the Databank B fund as a case. Again, based on investors' objectives, they will want to realize some sustainable growth in the medium to long term. It means that they can take risk, but they cannot take as much risk as an investor in EPAC will be able to take. And so that asset allocation will also mean that it needs to be predominantly fixed income and some investment in equity, just to provide the growth that the investor is looking for. Can you please answer for me? Yes, so again, you can see the asset allocations. We have then there is an allocation to cash to ensure that investors' redemptions are met timely. And then we have some investments in collective investment schemes. So for a fund like Balance Fund, ordinarily should be able to invest on its own, but for it to be a CIS or a collective investment scheme, investing in another collective investment scheme, there is always a reason for that. And one of the reasons for us is trying to manage the liquidity such that all our money, most of our monies are in M fund, and you can easily get it back to pay investors on time, timely, once investors fill in the redemption. Another opportunity, another advantage of that too is that they can buy investments in EPAC just to have exposure to the other market without directly having to go to buy shares in those markets. Next slide, please. And this last slide on our example touches on fixed income funds. Generally, the goal of investors is usually to preserve their principal while generating some returns. So they don't have the appetite for their funds to come down even 1%. And so with that, you cannot take risk with those funds. What you do is just to try and minimize the risk that you take as much as possible, putting it in very secured fixed income instruments. And so in there too, you have some allocation to cash, some allocation to Government of Ghana securities, fixed deposits, and then corporate bonds. Next slide, please. Okay. So I have talked about what collective investment schemes are, how they are structured in Ghana, how they differ in terms of their asset allocations. And this slide essentially summarizes everything. So if you don't remember anything at all from this session, just take this slide with you, please. So for CIS, we started with pooling the monies together from investors. The money sits for a mutual fund with the custodian in the case of mutual funds, like I said, or in the trust account to which the trustees are the signatories in the case of unit trust. Now, having pooled these monies together, there comes the time for us to take a decision. And that decision is taken by the professional fund manager. And so the manager, with knowledge on the market and economic conditions and expectations, will have to consider the fund's investment objectives and restrictions to seek all the necessary approvals that is needed before the monies are deployed, and then buy the securities for the fund. Now, after the purchase of the securities, we are to put them together as a portfolio. On daily basis, these securities are valued by adding the interest and dividends that accrue on the securities that we have bought. And that leads to changes in the price of the unit trust or mutual fund that you have bought. And for the vehicles that have equities, changes in the daily price of these shares are also taken into account. And then you will have to take out your fees to determine what we call the net asset value. The net asset value is essentially the total value of the portfolio as at a particular date, minus any liabilities in the form of fees and charges that have been incurred on behalf of the fund. Now, after determining the net asset value, you now need to determine the price at which investors can come in and go out of the fund. And that is done by dividing your NAV, net asset value, which is the output from step 3, by the number of shares or units in the fund. And there you can see that I've written bid and offer prices. It's just as a professional, you should know the difference between the two. For funds that have front load, so front load, I did mention earlier on that by virtue of you hiring or getting a professional to manage your fund for you and to administer it for you, there are some funds that you charge front load for the distribution of the fund or exit load. So for those that have front load, you realize that their bid price and offer prices are different. And so when you are coming to buy, the offer price is what is used, and that is usually slightly higher than the bid price, in that the front load in Databank, for instance, the fixed income fund, which is M fund, has 1% commission, and that is fed into the offer price. And the offer price is the price at which the fund will sell its units to you, the investor. And so that 1% has been fed into that price. And the bid price is the price at which the fund will buy units from the investor. And so when you are selling or you are liquidating, that is the price that we use. And I wanted to make that distinction very clear. So in you educating clients, it will be very easy for you to walk them through that. Now the process ordinarily ends in step 4, but step 5 is to help you to compute your return as an investor, or to be able to advise or help clients to compute their return. So note, very, very, very important that unit trusts or mutual funds do not guarantee returns. The return is determined by the daily changes in the price. And so for you to be able to look at, as a client, what your total returns is for you to look at the daily price change and multiply it by the number of shares or units that you have. And that is the way we are supposed to teach our clients how to compute their returns. We cannot go and guarantee returns that if you invest in Databank M fund, you will get 20%. That is not right according to the law. And so if the SEC gets you doing that, you shall be dealt with. But as a professional, and as we are all learning from here, I think it's very key for us to know that mutual funds, unit trusts, on their own do not guarantee returns. And by that extension, a fund manager who has been registered under the SEC cannot offer products that are guaranteed in return. That belongs to the bank because they have the muscle or their books are sufficient to be able to accommodate any shocks that might happen if the investment goes bad. So that is one thing that you should walk away with in this discussion. And so this brings us to the end of the section on GIS, but I would like to take the opportunity, like I said, to walk you through some skills you need to succeed in the industry, either as a fund manager or as a relationship manager. So as future professionals, indeed, you need the qualification, the course that you are taking now. You need that, of course. Without it, the SEC is not going to even license you for you to be able to give advice to anyone. So that is the very basic, that is the fundamental. But in addition to that, there are some skills that are required for you to succeed in the industry. And I would like to take this up to just walk you through 6 of them. The first is that you need to be humble. And why is this necessary? As a professional, you have been entrusted with investors' money. And not acknowledging the fact that these are other people's money, as you call it, OPM, you might be tempted to take uncalculated risk, which could have its own negative implications. So I know, and the investor knows, that you are very knowledgeable in your space. But please, 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 just recognize your limits. And when you are in doubt, don't hesitate to discuss with your team in order for you to take a decision, bearing in mind that the money is other people's money. OPM is not your money to take any kind of risk that you want with it. Secondly, you must be a good listener and have the ability to communicate clearly. Any misunderstanding or miscommunication on your part could cost your company or your organization and even you your job. And in some cases, depending on whether you are you belong to any professional organization, that could go against you. So please do make sure that you listen very well. You are a good listener. You are listening to what your clients are saying and providing solutions according to what they need. You do not go into the investment space with a mindset that, well, I'm going to sell M-Fund to you, no matter who you are, whether you can take risk or not, I'm going to sell you EPAC. That doesn't work. You need to listen to the client, let the client listen to what the client needs, what the client can accommodate, and then you can help the client take a decision. You do not take the decision for the client. You help the client to take the decision. And then thirdly, you should be able to explain very complex information in very simple terms. For instance, instead of asking a client, what is your risk appetite? Or what, yes, I'm not sure how many average investors will understand that. So you can put it in a question that goes like, if your investment goes down by 20 cedis, assuming you brought me 100 cedis, what will you do? And that will give you a better sense of how the client is thinking and how the client is likely to react in case something goes wrong. In that case, then straight away you know that if a client who is likely to be violent with his or her money going down by 20 cedis or even 1 cedi, then obviously the client doesn't belong to you buying equities on its portfolio. You are just straight away going to a fixed income fund where you have very steady returns but taking very low risk for that matter. Please answer. Okay. And the fourth one is that you must be able to network. I know some of us might be introverts, but you can't be your only client. You can't sell to your own self for the company to survive. You need to reach out to the investing community to make money. So you must be ready to stay connected and go out of your comfort zone to ensure that you get some business for your company. The fifth thing is that you must have a very strong drive and desire to succeed. You won't win every time. It doesn't happen like that. And I can share with you and on a different platform what my experiences have been. But some investment decisions might not work as well for you in the very short term. You might not always win the clients you've been courting for months. But hey, you need to keep your head up. Put your best foot forward in every opportunity, and that is what matters. Just make sure that you are doing your best for yourself and for your company. And finally, make it a point to remain ethical and professional in all your dealings, no matter the temptation, because that is the only way we as professionals can continue to be in business. Our business, as you know, thrives on trust. If the investor does not trust you, if the issuer does not trust you, if your company does not trust you, then that goes our business. And so we must be professional and ethical as much as possible to be able to win businesses and for our industry to thrive. And so I will end my preaching here for now. And then hopefully I know I've not succeeded in confusing you, but if I have, please let me hear from you in terms of questions, and that will be it for now. I'll stand ready to take questions. Thank you.
Deborah, thank you very, very much. I guess they are ready to ask questions and make contributions. Let me also acknowledge Mr. William Mensah, who is one of our facilitators for our program. William, welcome, sir. So now, if you want to ask a question, just
Thank you, Alex.
And we'll call you to ask a question. But if you're not speaking, please mute your mic. Okay. I saw a hand coming up. The hand has vanished.
It's George Kojo Ani.
George, yes, please go ahead.
Deborah, thank you very much for your wonderful presentation. I have two quick questions. The first one is, where do you place hedge funds between mutual funds and unit trust? And do you have such funds in Ghana? And then my second question is, you said that mutual funds, you get tax benefits, but if you are purchasing individual stocks, you get taxed on dividend. I just want to know that, is it because mutual funds, the tax is shared across all the holders of that fund, that is why you don't feel it, or it is by law that if you buy individual stocks, you must be taxed the dividend? Thank you.
Thank you, George. So I'll just pick the first one. Hedge funds, so you realize that I moved from the global definition of CISs to the Ghana classification. So hedge funds can either be a unit trust or a mutual fund, depending on the setup. What hedge funds are just doing is that they are buying instruments that they might not own or hold by themselves, but they are buying instruments that someone is having, but they are using those securities to do their evaluation. So, for instance, in Ghana here, we do not have one because our market is not that much developed. If you have a rule about, there is a rule called short selling, where even if you do not hold fan milk shares, you can sell fan milk shares. So, for instance, I can get up and say that I see that fan milk shares are likely to come down. Sorry, I have some feedback. I can say that I have Based on my
Just a moment. Dabil, can you please mute your mic?
Okay. Okay, sir.
Based on my expertise, fan milk price is likely to come down. And so I will approach a broker and ask the broker that, well, I want your fan milk shares and I want to sell it. So I go ahead to sell it. Once fan milk price indeed comes down, I buy from the market and give it back to the broker. That arrangement hasn't started working in Ghana yet. And so for now, what we deal in is a physical instruments. We do not have hedge funds yet. In the case of the tax, by the tax law, by the Ghana tax law, investments or returns on instruments bought by collective investment schemes are tax exempt, and so they don't attract withholding tax at all. So it's not a case that we get to spread over a larger base, but it doesn't attract any tax at all. Thank you. George, is that okay?
Yes, please. Thank you very much. Thank you.
William, I guess, want to make a contribution?
No.
Yes, I just want to.
What we have is not a prerequisite.
The hedge fund question.
The process we organize is not a prerequisite.
The distinction between hedge funds and other funds are that hedge funds are complicated in their structure. So by regulation, they are limited to sophisticated and high net worth individuals. So they are not structured in a way that allows anybody to participate in it. So even though they are pooled funds, they are usually structured as limited partnerships or a structure that can limit the people who can participate in it. And it is usually reserved for high net worth individuals or people who have sophisticated investment knowledge, because they tend to use more riskier investing techniques. So that is the key distinction between hedge funds and other kinds of funds. And because of the way they are structured, their fee structure also tend to be very different from the way other funds are structured. So I just wanted to add that to clarify the hedge fund.
All right, thank you.
Thank you, William.
Thank you, William.
Where's the CM?
Yeah.
Yes, go ahead.
Please, I would want to ask that as the investment, are you the one in charge of probably making the predictive analysis and then trying to find out information so that you can invest, in a particular fund, or is a fund manager who is in charge of that?
Okay, so as the Chief Investment Officer, what you do is to work with a team that includes the analysts and the portfolio managers. You have analysts on all the asset classes, and so they do the analysis under your supervision. As the CIO, you need to ensure that models that are being put across, or models that are being used for prices, are what they are supposed to be. So you need to vet or properly supervise those models. Once those models are properly run, you get a universe, which you then, as a CIO, lead the team to submit it to your investment committee for approval. And once the investment committee approves that, now you have the universe that portfolio managers can buy from. And so if you pick like the Ghana stock market, we can't say that by now we can buy everything. Depending on how our analysis have gone, certain stocks might be excluded from our universe. And then now the portfolio manager will now determine whether those stocks that are in the universe are suitable for the portfolios that they are managing. And so a particular stock, let's say Fan Milk, might be suitable for one portfolio being managed by the same portfolio manager, but might not be suitable for the other portfolio, depending on a number of parameters, including client constraints, what clients are actually, as in clients' objectives and all that. So that is what I do. I work with the team to ensure that the right decisions are made. And so that justification of suitability then comes back again to me for approval.
All right. Thank you very much.
Thank you.
Andrew, is your hand still up, or you haven't put it down since you spoke?
My hand is not up, please.
Then please drop it.
Okay.
There's any more questions?
Please, I would like to know whether with the EPAC, okay, with investing in equity funds, I would like to know whether you also consider passive management techniques, or have a blend of active and passive management techniques in investing in equity packs. With investing in equity, I mean stocks and all that, whether you have you do that by using only active management, or sometimes you have and what are the relative charges with both investments? There's in a special case with Databank, how do you go about it? Whether or not there is such a provision, and the relevant charges between them and all that.
Okay. So passive investing will mean that you are tracking the index, and that you are trying to hold all the shares that are in the Ghana Stock Exchange Composite Index, in the same weight that they are in. And that will mean that is an exchange traded fund. I did mention that from the beginning. That is not what we are doing. What we do is that we are doing active management. There is a downside to the exchange traded funds, and that is why we've not seen one on the market for Ghana. By virtue of the setup of our composite index, you would say that some would say that it's not investable. You look at the weight of MTN and the index, and that is almost 40%, which will mean that if you have a portfolio of equities, you should be holding about 40% in one stock, and that doesn't offer you much diversification benefits as a portfolio manager. So what we do is partly track certain stocks in the index, in that we are looking at, let's say, MTN. If my benchmark or how investors look at APAC is to look at how the GISI Composite Index is doing, then I will want to hold certain stocks in my portfolio, in addition to actively increasing, or we call it overweighting, my exposure to certain smaller stocks. So when I pick MTN, because I will want to be closely tracked with the performance of the index, I will overweight it in my portfolio, but I won't be able to get closer to the weight in the index, because by regulation you cannot even do that. Now, aside that, the other stocks like Fan Milk, AGL, Cowbank, they are very good stocks, but their weights are not as significant in the index. So how you can now beat the index will now mean that you need to take bets on certain stocks that are not heavily weighted in the index. And so we use a blend of that, but we don't do strictly passive management or strictly passive management. What we do is active management. We just include the tracking when we are doing our security selection and applying the weights to them, but we do not do passive management. If you read the literature, it tells you that passive fund management comes with less transaction costs as compared to active management. But again, once the market is not as liquid, you cannot go in and come out as well. When you are tracking the index, it means that if MTN goes up today, you should be able to find, or if you are, because it's an open-ended fund, if monies are coming in on daily basis, you need to be rebalancing the portfolio to match what the weights are in the index. And so that is not what we are doing. Please, does that answer your question?
Thank you.
Hello? Hello? Yes, please ask your question.
Okay, thank you. Another quick question. Earlier on you said that investment in equities are riskier as compared to money market funds. I believe it also goes with higher returns as compared to money market funds. But lately, for the past 5 years, I've been observing the two, and it seems equities seem not to be doing so well as compared to money market funds, although they are also the riskier. Is it that our market is not well aligned to this analogy, or maybe at a wider period it conforms to it? That's my first question. Okay, and then my second question is, can individuals buy stocks directly as done in developed countries, or must I always pass it through a broker? Thank you.
Okay, so let me answer the second one first. So you cannot buy equities directly. You need to go through a broker to be able to buy. I know the CSD was developing a platform in conjunction with the GSC where investors, but that was almost limited to sophisticated investors can log onto a platform and be able to put in your bids, or when you want to buy it or when you want to sell it, be able to put in there. The risk is that if you make any mistake, because it is automated, it goes that you watch it. But in any case, you should have an account with a broker that will facilitate the settlement process. So the direct answer to your question is that you need to go through a broker to be able to buy shares. On the second part on the performance of the equity market. So you realize that in the last 5 years, and you are very true with that. That is very true. In the last 5 years, in that same vein, the markets for bonds have been extremely active. You have seen that you find a lot of borrowing on the part of the government at very high rates. When that happens, investors' interest shifts from the equity market to the fixed income market. If I can get a 20% with certainty without me taking any risk, why worry about going to invest in MTN that may or may not give me the 20%? And that is a challenge we find ourselves in. But having said that, if you look at individual stocks, if you were invested in, let's say, MTN from the beginning of the year to somewhere March or April, you would have done about 90% if you can't get on the fixed income. So true, globally on the GSC Composite Index, you've not seen that much traction in terms of prices, but I believe that specific stocks, if you pick specific stocks, you will be able to make sufficient gains as it were.
Please, thank you very much.
Thank you, sir.
All right. William, you want to make a contribution? Then we go to.
Yes, I just wanted to add a little bit to the first answer about people trading directly. You see, what you are observing internationally is that brokers are giving you technology that allows you to remotely place your orders, but it is still going through their platform. Even here in Ghana, I know some brokers are implementing such technologies. Okay, so it's not like you are buying the shares directly. It is just that a broker has given you a technology that allows you to sit in your office or sit in your house or wherever it is and place your orders. But it's not like you are trading with the exchange directly. You are trading through a broker. It's just that the broker has given you some technology that allows you to remotely place your orders through them. So that's what happens. It's not like you can trade directly with the exchange when you are outside.
Thank you, William. Andrew, and then I saw another hand. After Andrew, yes, Andrew, you speak. I'm sure another person will raise a hand again.
Please, I wanted to find out whether, as a broker, I need to be aligned to an institution to perform brokerage activities, or I can independently help people, buy shares on the stock exchange and all that. And secondly, I would like to know whether MTFs are in place in Ghana, like there are multinational trading facilities in Ghana, like we have in the Western world, where sometimes they can match buyers and sellers. They have the systems that operate like exchanges that they can match sellers and buyers. We have such provisions in Ghana as well.
Okay. So I will attempt to answer, and I think William can add on if he has the knowledge on it. So you wanted to know if when you say as a broker, is it you as an individual or you work with an institution? Are you a broker, or can you please clarify that?
Okay. I get done with securities course and be given a license to become an investment advisory representative. Okay, I presume I don't know what has really changed with this license, but with those who used to do the Ghana Stock Exchange, they become licensed brokers. That is what I initially knew it was. So having such a license, you need to find yourself working in probably Databank or GISI Asset Management or somewhere before you can, perform those duties as a broker, or independently you can help people buy shares in and out of probably GSE composites.
Okay. So unfortunately, you do not become a broker by completing the course, just by completing the course, no. There are other things that you need to do, one of which you need to have experience in the trading to start with, which will mean that you need to be with an organization that is licensed under the SEC and that operates under the GSE as a broker. So you cannot on your own as an individual be a broker by completing the course. What you can be by completing the course as the relationship manager, which then also comes with some, some conditions before you will be awarded that particular certificate. So the answer is that you as an individual cannot be a broker on your own. You need to belong to a brokerage company for you to be able to trade on behalf of clients. Because I think that is also a check. You cannot, if we have freelance brokers, then that becomes a bit difficult on the regulator side to be able to ensure that monies that are given for brokerage purposes are being used for what it is, and it will be almost impossible for the regulator to be tracking individuals and be monitoring their progress. So it's much easier when they are working with an institution, and that is what is being currently done. And I'm not sure. There is nothing like individuals being broker. In that same vein, I cannot get up to say that I am a portfolio manager, an individual portfolio manager. I need to be licensed under the SEC based on certain conditions as an institution. So that is how the regulation goes. Does that answer your question, please?
Yeah, a bit clarified. By your answer, I'm okay, but then again, the process through which we have to go through to become brokers, would it demand that? I don't really know, but it's not going to be easy. And then, is there any provision? Is there any way you can get a sense? Probably you need to go and apply. You have to go and apply for a job at Databank, and then
Deborah, can I
satisfy?
Yes, please.
Okay, so the regulations of all the licenses that the SEC issues. The only license which by the regulation can be issued to an individual is an investment advisor's license. But even that, as we speak now, it is not being issued to individuals. But there's a provision for that in the law. So all licenses that are issued to individual professionals are linked to the organization for which they work. So for instance, if you work for Databank and then you have a license either as a fund manager or as a broker, whatever license you hold, when you resign from Databank, that license, whether if you know you have to renew the license every year, whether the time for renewal of the license has come or not, that license ceases to be valid. Now, if you move from Databank and let's say you go to SAS, you are not automatically licensed. SAS has to reapply for a license for you. Okay, so the only license that allows that you can hold as an individual is the investment advisor's license, which only authorizes you to give advice. You cannot hold any client's money. Remember that this is money involved, so the provisions there are supposed to ensure that people are protected. But even the advisory license, the SEC was coming up with some guidelines to license individuals. But as we speak now, they don't even license individuals as advisors. So the license is tied to a specific firm that you work for. Okay, so if you want to work in the industry, your path is to get into an investment advisory firm. The good thing for you is that now there are so many of them. When you come to the investment management space, the number of licensed investment management houses are so many. Okay, so the opportunities are wider now than it used to be when I joined, for instance. When I joined the market in 2003 or thereabouts, 2003. Okay, so that's what you have to bear in mind.
Oh, okay, thank you. Thank you so much. Thank you so much.
Almost there. Benjamin, I think we'll take your question and probably one more, and then we can call it an evening.
My hands are up.
Whose hand is up? I can see Benjamin's hand.
And Kenneth.
Kenneth, okay. Ken, please go ahead and Benjamin will speak and then we'll wrap up our session.
Okay, so Ken, thank you very much. Who should speak? Should I? Benjamin.
Ken, please.
Okay.
So
Kenneth.
This is yes, sir.
Please speak.
So, thank you. So, madam, I have a very complex question. Let me do this because yes, it looks a bit complex and sometimes it may look a bit simple to us, but it's something else we have to look at. So, because of the recent developments in the financial markets, let's say from 2018, the shake-up and stuff like till now, a lot of people find it difficult to trust some of the financial institutions, and I'm sure that's one of the reasons why we have this licensing and stuff coming in for individuals and stuff like that. But even with this one, we still have some gap in the market. Now, when you look at the demand and maybe the minimum capital that they raise for some of these firms, we have some of the institutions trying to go into or look for clients because some of them are just going back. And some of us, I do financial literacy. I'm a student, so I used to teach some of my colleagues about these basic financial concepts and principles. And because of these things we teach, some of them will look at us to help them with their investment choices because we try to explain this concept to them. And at the latter part, they tend to tell you that, okay, what will you recommend for us? So we tend to do some recommendation for them in the market. Later on, we got to know that it is illegal for you to tell somebody this product are good and this product are bad. But then the fund managers or the management companies don't come in to meet the grassroots investors. Is there something we can do that can help people who can at least do education to these people who need information? That it will not be as if we are doing a financial advisory, because when you tell them you're not a financial advisor, they'll be like, you don't need a license to become a financial advisor, because we have people who advise you who are not licensed to be advisors. So financial advisory has become something that we are doing on a broad general note, but because the licensing that requires or that require licensing from the SEC, we don't have that kind of, I don't know if you have that duty to do, but is there something that we can do that can bridge that gap when it comes to teaching people about literacy and doing recommendations? And what is the best option right now? Are we to stop with the literacy, or we have to continue with the literacy, but then the literacy will be limited to only people who have licenses or who are already taking this program or the GC courses? Thank you.
Okay, so I'll start, and I believe William will add on. Okay, so as someone who is not licensed by the SEC or the Securities and Exchange Commission, you cannot, and like you have mentioned clearly, you cannot advise clients as to where to put their money. The reason being that even with the licensed people, we cannot say that you should invest in this or that. We can only give you advice based on our knowledge. That based on my discussion with you, I can see that you want to invest for school purposes, for education purposes, you want to invest for emergency purposes. However, I've also seen that if your money should go down by a certain percentage, it's going to affect you badly. And so this is what I will recommend. Then you leave the decision for the investor to take. You cannot tell the investor that investor buy M fund, investor buy B fund, investor buy EPAC. That cannot be done, and that should not be done by a professional. Now, how do we bridge the gap between, let's say, students or class who wants to give knowledge or information to their members for them to be knowledgeable about financial literacy? You can do that kind of education without having to be a licensed person. That is just giving bare information as you have it in literature. And you can, in some cases, some investment companies, you can liaise with them if you have a club for them to come and speak to your people, or you speak with them, but at the end of the day, you shepherd the people to that investment company for them to close their investment needs with the investment company. At which point then, the only thing that you did was to give them the bare knowledge for them to take a decision based on that bare knowledge. But you are not required to tell anyone that you should invest anywhere. Even with those of us who have the license, we cannot do that. So if you have a club that you still feel the strong edge to ensure that they are well educated, these days with digital platforms, you can organize anything anywhere you are in Ghana and have professionals speak to your people. You can give them the basic knowledge and then invite professionals for them to speak to them and help them to take their decisions. But you are not supposed to take the decisions for them. Kenneth, does that answer your question?
It answers some parts, but then there's some other more that we will have to deal with. That has to do with giving opportunity to fund or maybe professionals to do the discussions. So I don't know if I can still ask, but when you give professionals opportunities to come and speak, they tend to more like sell the product that they have to some of these young investors. And for basic knowledge I have, I know that the financial products we have on the market are not usually the same. Some of their returns vary, and some of their charges and other costs that are attached to those funds also vary. Investors don't have information to these things, and they usually affect the returns that come to investors. So because I do this for almost 4 years, since I was in 100 to 400, I have reports and I have analyzed or put up the basic details about all these things and make it public for those who are linked up with. And when the managers come in, they still want to sell some of this product that when you do analysis, when you look at the results, you realize that they are, let me say, inferior to some of the other products. So in bridging this gap, you tend to be more like a demon, but trying to open up the space for other people to come into the market and stuff like that. I've been doing this, and I have lots of clients who are linked up with other firms. But because of the difficulty in bridging this gap, it's we are not finding value for what we are doing on the market space, but we are still in the market space. Because I run this club on 6 universities in Ghana. We are called the finance because that's what we've been doing for the past 2 years.
Okay.
So I can understand. Okay, Alex.
No, it's William.
Oh, William. Okay.
Yes. Okay. If you can, I want to commend you for what you are doing. It's a good job. Keep doing it. Now, look, if you should take various investment products and analyze them, show their return, show their volatility, show their consistency, etc., you are not giving investment advice. You are analyzing data. Okay, so you can do that and present it to your members. The problem is that, especially when you are talking to a group, you cannot go and say, invest in this, invest in that, invest in that. One of the things that you should put in your slide when you're educating people is that they should make the time to speak to licensed investment advisors, because what is good for person A will not necessarily be good for person B, even though they are in the same club. Okay, so you have to be careful about that. But do your analysis and present the information so that even if you invite a professional and the professional comes and he is hyping his product, your people have already seen the data. They can see for themselves that this does not suit me, this does not. As long as you give them adequate information and they know what to look out for when they go asking, they would be led to the right products that is meant for them. But you have to resist the temptation of recommending specific investments for them, not just because you are breaching the law, but also because you might be hurting people. The fact that that thing looks good for you does not necessarily mean it's good for another person, because your risk profiles will be different, your investment time horizons will be different. There are so many things that will make something that is good for you not good for another person. So you have to continue doing your education, but also be careful. The next thing too is that if you invite someone and all he does is to come sell his product, just blacklist him and go and get someone else to do the education, another professional to do the education.
Thank you.
The last question, Benjamin.
Yes, please. Thank you. I wanted to ask, does the GSC recognize CISI qualifications in order to be a broker, or would I have to write the GSE examination separately? Thank you.
Have you finished the GSE course?
I am yet to write the professional course.
You are yet to write it.
The professional exam.
That means you haven't finished, have you?
No, I haven't finished. I just want to have an understanding. I just wanted to.
So you just finish and then the rest will follow. Because until you finish, you cannot go and do anything. You have to be professionally qualified before you can do it. But to Ken, let me just say that 2 days ago, on Monday, there was a program organized by the SEC through the Ministry of Finance on the Capital Market Master Plan. One of the key things that they are going to discuss, if are going to implement, is investor education. It's something that has been on the board and it's part of this plan. So I believe that as they roll out the plan, this issue about investor education, which is a pillar of their preparations, would come up. But like William said, though it's in a way such as, you're breaching the law and hurting people's investment because of what you want. But we commend you for doing some analysis and let it guide you what you do. Okay. I wanted that to be the last question, but I can see George's hand up. I just want to... But George, can you be brief in a minute so that we can just wind up? We've gone past.
Thank you very much. Okay. Madam Deborah, I want to ask, a friend of mine got a huge sums of money and he wanted to protect it until he uses it. So I told him he should invest it either in a mutual fund or But a colleague of mine also told him that it's better he convert the money to US dollars and keep it. For that, he can get his money back when he convert it back to cedis. So I'm just asking, based on your experience, which one do you think will be the best option to keep your money in US dollars over a period of time so that when you convert it back, you still get the value, or invest it in any of the mutual funds or equity markets? Thank you. Based on your experience over there.
George, can I intervene here? This was quite personal, and I think that if you could speak with her outside this program, so that she can ask you a lot more questions.
Oh, okay.
Besides, the person who's investing is not you, so it's better that if that person speaks to her directly, then she can get all the answers to his questions. But it's a good thing. We're on the capital market and would encourage people to come to the capital markets. So that is one thing I should also take note.
And then, Alex, this highlights the challenge we were talking about. You see, you're giving advice based on very little information.
Exactly.
Yeah, you have too little information. So if someone comes to you like that, direct that person to talk to a professional. That's the best advice you can give to the person.
Okay, thank you very much.
Thank you very much. Yes, that is exactly what we wanted to say. Good. So on that note, I just want to continue to encourage you that next month is going to be an interesting month. We'll have a chat on corporate governance and risk management. We shall also be bringing together the Ghana Stock Exchange and the Ghana Commodities Exchange. It's an exchange that is not too much is known of it, but it's actually operating seriously in Ghana here. And so we'll be bringing those securities exchanges for you to understand what they do in the Ghanaian landscape. So let me thank all of you once again, the facilitators who joined us. Raz, do you have any word for us? Raz. Right, okay. So Deborah, thanks and thanks and thanks again. I'll send a very sweet email to show my appreciation for the work that you've done. I really appreciate it for standing in for us. So ladies and gentlemen, once again, God willing, next week Wednesday. We had it on Thursday this week because there was a program yesterday that the resource persons had to be on. But next week we are coming back on Wednesday, and as I said, we're going to have an interesting lineup for June. So please, Emma will keep giving you the link so that you join us and participate. Thank you and good night.
Thank you very much. Thank you.
Thank you. Thank you. Thank you. Thank you.
Thank